Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, September 25th, 2025. It's 12:24 p.m. Eastern Time, so I'm back at my desk. Wanted to go over some of the charts that I'm watching today. I'm going to start out here with gold, just so I don't forget it. I often start out with the markets and sometimes forget to get some of the things on my scratch pad that I have towards the end. Gold is right on that line. Here's that uptrend line. I'm going to tighten up nice and clean right here. By that, I mean come and catch the bottom of all these initial candles. And then these last couple here, you've had these two little stick saves. You could do this. I call that BOD, benefit of the doubt, or just loosening up the trend line. Come in and catch the bottom of those two. So let's just do that. We'll give it the benefit of the doubt because it's been very resilient trend. So what we're looking at here, you have the potential on GLD. Again, potential for an island cluster top. You have 4 candles right here separated by a gap on one side. Should we gap down tomorrow, it would be a double sell signal. It would give you that island cluster top, which is a potential reversal pattern, topping pattern, and it'll also take you down below that nice clean trend line and probably give you, if not tomorrow, or if it happens, let's say Monday, maybe it's possible you could, the island could continue to form with a cluster of candles here. So, but again, that the sell signal is going to be a break of that trend line I've been highlighting, and that should also bring us down, give us the first high-level bearish PPO crossover here on the daily chart in a while. That's not the one. Let me show you. That's the percentage above 200-day moving averages. PPO histogram right there. So again, I like these big green hills and these red inverted hills. These are trend indicators. When you get a bearish crossover, that's usually when a trend change occurs. Here we had a sell signal. It was similar. And what happens, we certainly had a correction in both price and more so in time. As I say, there's two ways things can correct. When you're going up, a correction can be reversal in price, or you stop going up and you trade sideways. It's what I call the hacky sack slash ping pong ball or golf ball analogy. We drop both on a concrete or tile floor. The ping pong ball or the tennis ball, whatever you want to use, is going to bounce, and that's a reaction in the other direction, whereas a hacky sack will just kind of sit there and hit the ground and stay there. So, and that the sideways correction is the more bullish of the two. So gold did that, worked off that. However, we've come full circle again. So there it is, setting up. And the reason I wanted to start there is because, as I've showed you many times, I don't want to do a super long video. You can pull this up if you want. Pull a 10, 20, 30, 50-year chart if you want of gold and the dollar. You will see very clear, unmistakable inverse correlation between the two. Again, there are periods of what I call brief disconnects when there's overwhelming buying or selling pressure on gold that can help offset that, but it's pretty much an immutable force where a rising dollar takes more dollars to buy an ounce of gold. So therefore, that's going to bring the price down, and a falling dollar takes more dollars to buy an ounce of gold, so that will lift the price of gold. And again, that's it's not a convoluted or some obscure difficult concept to grasp. So we did, as I mentioned yesterday, we broke out. The dollar's building on those gains today. We're at this resistance level right here, we're actually taking it out, 27.62. So if this rally continues, which would be my expectation, then that's going to get up here. And as I said, I know that a lot of investors, especially retail investors, they're not into this as much as I am. Professionals, they don't really watch the dollar. They buy gold, and they're going to be trained like Pavlov's dogs to buy the dip. So, as I said, gold may not get the memo right away. This is an incremental thing, each tick higher, especially, as I said, if and when T1 is taken out. That was the first target. We hit there, we pulled back. If that's taken out, I have a high degree of confidence gold and silver and GDX will start to get the memo then. It could start to get it now. I'm surprised this didn't break it down today. I'm not shocked. Like I said, it's gold, or the dollar, I should say, is still in this multi-month trading range. So that's why it's not a big impact on gold today. Many don't see it or don't see the charts the way I do or dismiss it. And we'll see. No, look, we could fall back down. We're not, we're within, or 27.66. I have the resistance at 27.62. So we could certainly fall back in there and close today. So again, it's something to watch. It's my expectation. But again, that expectation will be firmed up and my confidence will be firmed up if and when gold breaks down. and give you that trend line. As I showed you, gold did break down on the 60. We took out that little minor trend line the other day that gave us this correction. This is the last update I gave you. The technicals are playing out very well lately. We right to that intersecting dual uptrend line and price support I gave you in, I guess it was yesterday's video, would have been the most recent update, give you these levels here. And so gold is, bouncing. The buyers are coming exactly where I expect them to. That's what they're going to do. They're going to buy a pullback to support. Where else do you buy? And you can buy a random pullback. Some dip buyers do that. But in an uptrend, if you want to do it objectively as a trader or investor adding on a position, you buy a pullback on a correction to support. And the way it works, support is support until unless broken. If broken, then that opens the door. I'm going to tell you right now, there's a little gap right here. This gap, that's potential support. But you can see my next nice support level is right here. Target 333.23, and that will again give you a bigger drop in GDX, most likely if that happens. GDX, as I mentioned, recently broke that short-term minor uptrend line. Kind of flat today right now, so far today, and you have a target of this uptrend line right here, and probably traders are going to be looking at this reaction low as well. So that's going to give you about another if hit, at least. Again, that's a minimum target there. That's about another 5.5% drop, which would from the highs take us down about a 9% correction in GDX. So watch that. So far the dollar is, like I said, moving up, despite the Fed just starting on its most recent first rate cutting cycle in a year. And then I gave you this one yesterday as well, told you what my expectation was, and that expectation has materialized. A breakdown of this bearish rising wedge in the euro US dollar pair. Again, the biggest component, 57.6% weighting the euro is of the dollar index, so that helps to that's a sell signal there in the euro, most likely going to take it down to this target here. And again, falling euro, falling EUR USD, or falling euro, you want to look at it is because of a rising dollar, they move inverse because of that mathematical relationship in the dollar index. And so that's that. So there's your update on gold. And then I also want to talk about TLT, or really TYX, the yield of the 30-year TLT. And so far that trend continues. We had that one little red day in yield where yields pulled back a little bit, and exactly where again expected, because TLT hit our price target on the 60-minute chart. That last pullback trade gave you here, short there, cover here, and so we're at support, positive divergence. So the Treasury's TLT, the 30-year bond, should, quote unquote, should bounce. However, I don't know. Again, I'm not engaging it right now. Here's your setup. I can tell you all day long, 6 ways to Sunday, this is an objective long entry. This is a bullish falling wedge pattern back to support. You're in a near-term uptrend, intermediate-term uptrend on Treasuries. And it's a setup now. You want to see this trend line, that downtrend line. That's a bullish falling wedge, 60-minute chart, just like we had a bearish rising wedge here. Well, there was the wedge I gave you initially. We broke down. We had that little kickback rally. And that was all that post-Fed, pre- and post-Fed noise right there. So it was just to be dismissed almost completely. You're going to get that kind of volatility around the Fed. And all it did on the technicals, it just made a higher high, a slightly, ever so slightly marginal new high, and still very much divergent high. And so now this is a divergent low. Okay, hold on there. Let me just put this phone on mute. Got a lot of text coming through right now. Mute that. Okay, so there's the setup. And again, you take it where to. Just, Treasuries. Look, if you've traded Treasuries, I shouldn't have to tell you this, but I often do. You take a much larger position size than you do on stocks. Treasuries move in small percentage terms, so you can leverage up, and take 2, 3, sometimes 4, depending on the trade and my confidence. What I would take on, trading the NQs, the NASDAQ 100 futures or something like that. So there's your setup. If it bounces, that should, quote unquote, again, I use my little air quotes, should be bullish for the stock market, because that would be if Treasury bond prices go up, then yields are falling. However, the situation where falling yields is not bullish. It's when the stock market is falling, especially on an impulsive sell-off. You get that flight to safety bid. So they can be mutual exclusive. And quite often I'll do this. I'll throw these out as a paired trade for you, where if you're short the equity markets, which I've given you the reasons to be today and the last few days, you can take a long on treasuries as a either right now a pure play, direct play. Your stop is simple. This was support. It was good support. We shouldn't go much below there. There's a reaction, top of a gap. Stop should be somewhere right here, not far below that that little reaction low right there. So it can either be a pure play long or a indirect hedge to your a short on the market. Sometimes those indirect hedges don't play out. You know, both things can go down, but I like it or I wouldn't share it. It's just an idea for you there. Alrighty, next up, let's talk about, let's just dive right into the equity market. Somebody asked me, because I just got back, let me pull that up. Okay, here it is. Mike asked, hey, when you get back, can you give us a good reentry point? All right, so it says 1 second ago I did it 15 to whatever. These charts are time stamped. You can check it out. I haven't refreshed the page, so that's why that didn't refresh. Just got back. Now looks to be a good time to re-enter a short. Covered at support. Those targets at the open today, in my opinion. QQQ offers an objective short entry here at the 595.10 resistance, which is my preference. I'll explain that in a second as to why. And or up to the top of today's gap, which also comes in with downtrend line which is resistance, the downtrend line off the recent highs. Here's a 60-minute chart. I've been giving you, I zoomed in a little bit and added. So there's a downtrend line off the highs, which if we push a little higher, will still be an objective entry. And technically, this is a doji candle from yesterday's 60-minute chart, the close. So technically, that's the top of the gap. But I always look at a candle, and if I see a reaction there, sometimes I'll kind of treat that, if you will, as the top of the gap. So again, the gap is technically from where you close the prior day to where you open. So there's your gap right there. And that's a red candle. And so you can see once we had that gap, there was that next 60-minute candle tested it. We had the kickback rally. That's why this morning, remember, the first candle of the day is only a 30-minute candle, right? So this was that target I gave you before on QQQ. And so we had those order imbalances. That's why I tell you want to wait for those. You know, you can get in early if a support level is broken. But when you're down as much as we were, look, we haven't had a 1% day for it seems like forever. And we were down 1% today after already being down, you know, for several days. This is the biggest correction. As little as it is, percentage-wise, it's the biggest correction we've had. And again, dip buyers after such a ravenous bull trend are like Pavlov's dogs on steroids. If he hasn't fed them for a week, they're going to salivate. They're going to buy the dip when the bell rings, and the dip is a breakdown. So that was today. I had to get that post out to you pre-market. I had to leave before then. And so they initially whipped back up here. I'll show it to you on NQ in a second. But either way, so that was only a 30-minute candle. The first candle of the day on a 60-minute chart only goes from 9:30 to 10. So this is your first 60-minute close. Close right back on support, bounce. And so why here and not here? I'll tell you why. Because where I think things are going, I made it very clear. I think there'll be more downside to come. I don't think this is the end of the correction based on the technicals, my read on the charts. Right or wrong, that's my opinion. Here's a good level, maybe not to initially stop, but to stop adding shorts. If they take out the downtrend line off the highs and they take out this gap, if they don't reject it, sell it at the gap, that's going to be near-term bullish. I can't spin it any other way. Near-term bullish. This is a 60-minute chart. So you may give it a little room on your stop if you shorted here. You know, we had a short entry here on this breakdown. I gave you a short entry on the kickback there. That snapback rally that morning or whatever it was, told you that would be an objective entry on the bounce. So we've shorted the best possible shorting points since this one here. And now, again, your entry will determine your stop, and that's going to be relative to where you think things are going. Maybe you caught this. Maybe you've just been buying dips. You're looking to buy dips, pullbacks to support. But maybe you just wanted a little quick pullback trade. And if so, then this morning was a great time to harvest profits. Again, biggest drop in a while. But, you know, if you're swing trading, that's not much. You know, there should be plenty more meat on the bone if we go down to these deeper targets. But Okay, so the reason why I said my preference is to short here, my preference right here, and not wait. It's look, it's a minimal amount, and that's part of the reason. I'm not going to try to pick up nickels in front of a steamroller. And if all eyes see that level and people want out, it's been a hot market lately. And I see the stocks that are going up, meme stocks and just AI bubble stocks and all that stuff. And I just know what kind of traders are engaged in this market. It's a momentum market. It's a game of musical chairs. And when that music's playing, it's beautiful to be in. But when the music stops, you don't want to be left without a chair. So what happens is people will start to say, okay, I'm going to start booking profits. So if everyone's waiting for a bounce back here to short or to sell their longs because you know what, it's time to get out. Too many eyes are looking at that level. And what they're probably going to do is step in early and sell. And if I'm wrong, guess what? What am I going to risk by going, heavy short back at 595.10, which I did. That's why I said that was my preference. 0.18%, 1/8, less than 0.2%. So I'm not going to get greedy trying to milk that out and miss the turn. So I like to, just the same way when I'm long and I have a, price target at 100 on a stock, I'm not going to wait to put my sell limit order at 100.00. My sell limit order is going to be at $99 and, whatever it is, 28 cents. So pick some number that I think is just comfortable enough below in case the sellers step in early. Same thing here. Okay. And again, it's no big deal. If I can give you a bunch of levels. Here's a level right here, a little what I call micro resistance levels. So there's plenty of resistance. That one right there is resistance. There was your breakdown point. But this is kind of the no shorting zone, no more adding short zone in my opinion. And then anything north of that, just scale out. They're just going to keep ramping this market. There's a lot of, there's a ravenous bid to the market right now. A lot of risk on trades, and that's it. It's like I said the other day, I certainly cannot, nobody can dismiss or completely rule out the potential of a blow off top. I've been through enough markets and traded not just the stock market, various commodities and crypto and other things, and know that they can and do happen, and these are the kind of environments they happen. I also don't like the fact that almost everybody's getting on board with that scenario lately. A lot of analysts, so-called experts, pundits in the media, and therefore that's starting to become too much the consensus, and that's why I wouldn't bank on it. But again, I'm going to trade the charts, take it day by day, tick by tick, minute by minute. Here's one I wanted to highlight for you. So we just closed out. I was gone, but it's still there. Lithium hit that sixth and final target I gave you. That one was first highlighted in a video back here. That was the initial entry point there, 50% gain. Congrats to those of you that caught it. And as I said there, if you think there's more upside, I'll give you a nice clean up trend line. I'm going to tighten it up. There it is. It's a little cleaner right now. What I mean, I just zoom in, make sure I'm catching the bottom of these candles here. And there's your stop if you think it has more upside. In other words, whatever. It can go. I can see the potential for a little more upside. I just think we've sheared most of the meat off that bone. That's it. Just take your 50%, move on to the next one. But what I wanted to show you, another one that hasn't yet played out, but I think has tremendous potential, especially, and hear my words, especially if this market starts to show evidence that we've topped, goes on to break out those next targets I've given you on QQQ on the 60-minute chart. This will be a monster short trade here, Carvana. We already shorted it recently, most recent entry, I believe, right here. Put in an island top, which remains the top right now. That's a single candle separated by gaps on both sides. Gave you this trade recently with the suggested stop on a daily close above 400. So far, we're okay there. This thing's holding that 50-day. See this yellow line? It's been holding that 50-day. That's the 50-day exponential moving average, like a world champ. But when it goes, it should open up. Now, the thing about this one is, the car companies. So I have 3 car dealers in my things to watch list. I cover that with you guys a lot. I have a watch list. It's grown now. I have 40 different individual stocks, sector ETFs, got other things in there, and it has 40 total things in there. 3 of those are car companies. And so America's Car Mart, car dealerships. This one, you don't have to be an expert market technician to see this thing's in a bear market. It ended with that bearish rising wedge, like so many that break down. Sometimes you break down, that's it. And sometimes you go on to make a marginal new high, keep that divergence going. And so when you broke the trend line, you didn't have the divergence. You had the divergence after the back test. And that was it. And this stock has fallen from that point 82%. And this is exactly what a bear market looks like. You don't have to be, again, an expert chart reader to say this stock's in a downtrend on all time frames, long, short, intermediate term. And it's just recently gapped down on earnings, big gap down. Today, we had there's 3 in my list, CarMax. CarMax reported earnings, and this one is considered largely a kind of a tell on the car dealership. So as you can see here, this is from whatever, you can read the news headlines, CNBC, but the CEO talked about a challenging market conditions, cited some reasons why, but shares of other car retailers were also down after CarMax results, as many investors and Wall Street analysts watched the company's performance as an early barometer ahead of other quarterly reporting. And so, you have the other car dealerships in there. Birds of a feather flock together. If I just showed you 2 of the big players have just gotten the snot beat down and their bear markets and CarMax is going up, there's a lot of speculation, and I believe that CarMax has fuzzy math, fuzzy accounting practices, and whatever. Bottom line is, we shorted on the technicals. So I just wanted to show you what's going on today. CarMax taking a bath, down 20%. And again, down 20%, not just off the highs, because it's gotten ahead of itself, it's overheated. These stocks are in bear markets. This is showing you what's going on in the the car dealership industry. It's down 72% now, peaked back in 2021. So what is Carvana selling? They putting little bags of funny stuff, CVNA in the car, little magic potions or something. All I can tell you, they're selling cars, and I know their models built largely on the financing. But either way, guys, it's a trade. Take it, don't take it. It works out. It doesn't work. We've had some that panned out very nice on this. We've had a couple over the last couple of years that have stopped out. We've had more hits and misses, and the hits we have been huge on this one. So these are just initial price targets. But I can tell you, if we take out my second target, T2, we'll also have taken out the 200-day moving averages, and I will most likely add additional targets. You can see some marked levels there. So just want to say, I think it's objective today. Well, we're back where we shorted it the other day. You can go back here. Just go to the site if you want to find the previous setups on it. Trade ideas, it's an active trade short. Click on that category. CVNA right here. And there's the entry on 9/11 right there. So like I said, we're back to where we broke down there, and it still looks good. So I wanted to highlight that one. Let's do a real short video. Funny because I didn't say I'd try to keep this one short in the beginning, but I just, I'm catching up on the charts. These are the things that stand out to me so far today. As always, I'll continue to pour through the charts and see what else is out there, and we'll see where we go this week. Like I said, just going back to the equity markets, look at SPY. We're coming off that most recent trend line break, sell signal there, rolling over, big divergence, starting to move lower. IWM, that's also broken down here below this is that primary uptrend line on the daily time frame. It would take a hell of a stick save. We're only down 1%, nothing big, but clearly below the trend line right now. And as I mentioned just yesterday, This sucker is at massive resistance. This is triple top high. The smallies peaked back in 2021, fell to the bottom of this range, put in a divergent low, hit my third price target. I gave you a total of at least 4 targets back then, and it's all just like the stock, the S&P 500 and the QQQs. Just a continuation, in my opinion, a marginal new high of a long-term call that I've made, a year or two ago, especially in QQQ and SPY. That's just taken a while to play out. This is a topping market. Now you might see a high level consolidation, a breakout to come, and hey, if that's the case, don't fight it. As I said, it breaks out, that's bullish. Somebody asked the other day about it, and I said, if it breaks out, if you're bullish, you can buy a back test on the breakout. You can buy the breakout if you want to take it on face value. It's about 245.35. But my money is on the fact this will fail. And when it does, so a breakout and a failure back down below the breakout point, and or they coming together, this primary uptrend line right here off the April lows will trigger a sell signal. And from my experience, breakouts that occur with such conditions, overbought, negative, big negative divergence. This thing's been, you have equal highs in price with lower highs on the indicators, both the RSI and PPO. That's a massive setup, in my opinion. In the triple top pattern, you simply take the distance from high to low and you add that, which I did months back for you. It was a double top when I first did this for you. It was a double top. And then we hit the April 5th. 6 lows, had to cover for reasons cited at the time, expecting a bounce, a little bit more bounce than I thought we'd get, but either way, it just took us back to resistance. And so the pattern when you get in these trading ranges is typically you want to sell the highs, get out of your longs and or short, and then cover and buy the lows. And especially that midpoint. Midpoints usually come into play right there. So on the way down, often you get a reaction. But the point is, once you reverse and get going, the next stop, even if you have a reaction at the midpoint or not, is usually the bottom of the wedge. So that in itself, just let's say we get that, that's a 35% give or take drop to there. Then if the pattern breaks, a triple top pattern, you take the bottom of the range right there and you add it. That's what I did here. There's your triple top target. That gives me a long-term target of 107.54-ish, we'll call it, on the smallies. And let me just tell you what that would equate for. 107, right about there, 56% drop. And that meshes with what my longer-term targets on the Qs and S&P 500 are. So that's kind of big picture stuff. But again, that's big picture. Most people don't have the gumption or the discipline to hold on to that. And again, that's got to be your trading plan. That's a long-term swing/trend trader or investor kind of outlook. Near term, if you're trying to trade, and you're using 3-4% stop losses and you're taking profits on 5-6-7% moves, that's the realm of a swing trader. That long-term chart really doesn't come into play too much. But I think you should factor it in, take a look at it, and watch what happens on the smallies. So, as I said, most important development today was on this one, the daily time frame, that breakdown there. All right, I will wrap it up here. We got it in under 30 minutes. This has been Randy Finney with Right Side of the Chart. Have a great day.